Hey everybody, I hope you all are doing good. In this video, I wanted to talk to you guys about a phrase, a common statement that I hear very often from a lot of investors, and they would say things like, I hold things for the long term, or somebody who's a bit more familiar with the stock market or a bit more qualified or educated about the stock market and how things move, they would say things like, I like to follow Warren Buffett's advice, and he advises us to hold stocks for at least 10 years or longer. And if you're somebody who plans to not hold stocks for 10 years, don't even bother buying that stock. So, this is a common statement I hear very often, and I'm sure you hear it, or you might be somebody who says something like this or who follows this advice of Warren Buffett. Have you heard the saying that incomplete knowledge is more dangerous than having no knowledge at all or ignorance? Something of that sort, right? I'm sure you've heard this. And in this video, I'm going to talk to you guys about that. How this advice, first of all, is if you are somebody who follows this advice blatantly, first of all, it's a incomplete advice and it is extremely dangerous to rely on this common investment wisdom and follow this advice blindly. And in this video, I'm also going to be sharing 5 reasons why this advice really does not apply to 90% of investors today. And if you stick around the video till the end, I'm also going to talk to you guys about what the complete advice really is. And if you're somebody who believes in following this advice, what is the right way to follow this advice and get the maximum return from the market following this advice of holding things for the long term. Before we get started, if you're somebody who's new to this channel, well, first of all, welcome. My name is Shaun. I'm an active US equities trader and investor. And on this channel, we talk all about investing and trading the right way. So if you're interested, consider subscribing. Now, without further ado, let's get started. Now, getting started, the very common thing I hear from a lot of people or a lot of investors is they'd say things like, I'm holding for the long run, right? Now, when they usually say things like that, they're rarely following a sound investment advice, but they're generally just following a mantra. And they're basically following this mantra and hiding the fact that they're just being lazy in terms of learning, educating themselves, and doing somewhat of a research and building a thesis behind the investment. Because if no matter what stock you buy or what asset you bought, if it quadruples in value or maybe goes up 100 folds based on luck, that is still a gamble, and maybe your gamble just paid off. But most commonly, it doesn't really happen that way. Most people end up losing their money when they don't really put in the work and research or have a solid system or a strategy, a way to manage risk. What generally happens when people buy the stock, and this is just, I'm talking about an average person who has some interest in investing and they sort of dabble into the markets. And what really happens is they hear something about a stock or maybe another different asset or something, and they see the hype, all right? They see the hype and they feel the FOMO, right? Fear of missing out. And when they feel these emotions, they just want to have a piece of that action, right? And the problem with that is, and this is what most commonly happens to a lot of investors. What happens is a stock just goes up in value, right? And at this point, nobody's really talking about it. Stock is doing really well. If you're somebody who's really in tune with the market, doing it day in and day out, you kind of get to know these big percentage movers and you find out what the reason is. And if you understand the fundamentals of what's really going on, what's driving the demand, what's driving the price movements, then you just happen to be the first one and you just see the momentum and you catch it as somebody who's really involved in the market, right? That's what professional investors or professional traders are doing day in and day out. But what happens is nobody gets to know about this particular move except the insiders, right? This move until over here, right? And this asset just keeps on doing well, right? A little bit more people start to talk about it, get to know about it, or 20% move, 25% move. Now everybody's just talking a lot about it on the street, but it's really not caught on to major news outlets or news channels or media yet, right? And it keeps on doing well. Maybe there's a real value around it. And around over here, this is where general public gets to know about it, and every other news channel is talking about it. And all this way, news channels don't really have a reason to cover it because it's just another 10, 20, 30% move. But the moment an asset reaches 50%, 100%, 200% move, that's a big headline story. That's what gets the most amount of clicks. And that's how a general public actually gets to know about this asset. And they fall for the hype, they feel FOMO, and they want to have a piece of it. And I wish I would have started drawing this chart a little bit lower, but anyways, this is where an average person starts to get involved into this asset, right? General public. And maybe the stock does really well for a while before it starts to come down. Oops, it's just not clean enough. And it starts to come down. And the general public is still, or the average investor is still thinking about, okay, it's just dipped a little bit lower. I believe, this asset, whatever reason that they saw this asset to be doing well, that still holds, or, it's still a good investment. Everybody's made a lot of money. I'm going to hold on to it. And they're not really worried or panicked at this time. But the asset keeps on dripping a little bit lower, right? And then they start to worry a little bit. And guess what? Most people, when they're doing this, they're not looking at research or reasons of what's really happened. And what they're really doing is they go on the internet, they start searching for why the investment is the right investment. That's what most people do. And guess what? It's 2025. If you look for anything to be right or wrong, you're going to find those reasons to be right or wrong. And this is what they keep convincing themselves, that this is a good investment, and just keeps going down and down and down. At this stage, they start to panic. And around here, they really feel, after holding things for the really long term, they're like, okay, I finally give up. I might be wrong. I lost my money and that's it. And before you know it, once general public exits, things just start reversing again. I'm sure you must have seen it or experienced it. Maybe if not experienced it, hopefully you haven't experienced this, but I'm sure you've heard these stories and you've seen these stories. And the reason why this happens is most people get to know, or at least people who are involved in the markets, they get to know about things because they're just in tune with the market. They get to know about things a lot more earlier. They ride the wave. And when everybody gets to know about this asset, this wonderful asset, it's usually a time to take profits, and professionals just know when to cash out of their investment and take profits. They have a very solid exit plan, because any investment is not an investment. It's just a piece of product in your portfolio. Basically, it's just an inventory. It's just a showpiece, for lack of a better word. It doesn't become an investment, or it doesn't really translate, that investment doesn't really translate into real profits until you exit and cash out and take your money, right? Until then, it's just something on paper. That's it. And this is what happens to a lot of people. They go through this ride and they follow this I hold things for the long run advice. And when things are just crashing, that's where they really exit. And it's very few people who would actually still stick around with this asset right over here. First of all, majority of assets rarely even come back. In fact, 80% of the assets never really come back. And even the 10-20% assets that actually do have genuine value and they start to rally back up again, majority people, 98% of people are not really going to be sticking around and to capture the second wave up, which could be much more higher or bigger. And that's unfortunately the sad reality that most people experience when they dabble into the markets, regardless of what advice they follow and whose advice they follow. They usually end up, if they're not teaching themselves properly, or they're not going through the proper educational channels in their trading, this is usually what they experience. And if you are somebody who's experienced this in the past, or maybe you want to be proactive with your own investing and really just make sure that you never go through this experience yourself, and you want to learn how to actively invest in the markets the right way. And when I say actively invest in the markets, I mean holding positions for 2 weeks to a few months and investing in solid, fundamentally solid companies. And if you want to just grow your portfolio in less than 5 minutes a day, feel free to check it out. There's a link in the description below. Check out my website, and if it sounds like something you might be interested in, feel free to schedule a call with me through the website, and we'll get in touch, and we'll see where where things go from there, and if I'm somebody who will be able to help you with your investing journey or not. But getting back to it, when we talk about Warren Buffett, right? So here are five reasons why Warren Buffett's advice doesn't really apply to most of us. And number one would be, let's say Warren, actually, just remove this, talk about our, hopefully, a friend, Warren, right? The very first problem that Warren Buffett has, and it's his own separate problem, and we are just not in that position to have that problem. So that's the reason we really don't have to act like him, because we are not Warren Buffett. Any of us are retail investors. If you are somebody who doesn't manage hundreds of millions of dollars in your portfolio, then yeah, we're not Warren Buffett, and we don't have Warren Buffett problems, and we don't really have to act like Warren Buffett, right? And the number one thing is huge capital, right? See, the problem Warren Buffett really runs into is he's managing such a large capital amount that there's just no way that he'll be able to get in of the market or get out of the markets just so easily. It's just what it is, right? I mean, moving that money is just not easy. And to make things simple for somebody who's just not super familiar with the investing, here's what actually happens, right? And what I'm going to do is I'm going to use a house or property market as an example, because property tends to be, property is actually a tangible asset, and I feel it's just a lot more easier way for me to explain my point, what I mean by that. So let's say you're an investor who has $20 million in capital, and your goal is just to make 5% on your 20 million. And if you can make 5%, you'll be super happy. And let's say we end up finding this absolutely gold star property, this amazing new development that is happening nearby, and this potentially can generate us 5% returns a year, right? So we are really happy we can invest our 20 million into this house. And what's the price of this house? 1 million each, right? Now it's a new development. So all we have to do is go to the developer, tell him that we just want 20 properties and that's it. But here's the problem, right? When we talk about this house, right, my drawing skills, there are only 10 of these houses. Now what we do, even if we wanted to invest all our 20 million, we're going to run into a problem where we just cannot invest all the money. We'll be able to invest 10%. Sorry, 10 million. And by default, on our $20 million that we have, with our 20 million, by default, we are stuck at getting a 2.5% return no matter what we do, because there's just not a lot of inventory. And here's the thing, when it comes to hedge funds, right? They have billions and billions and billions of dollars. And even if they want to buy a large amount of shares, first of all, it's very hard to get those inventories for them. Just how easily it would be for you and I to just go to your broker and just hit the buy button and we are in. So it's not very easy for them to move around this capital. And especially when we're talking about investing $1 billion or a few $100 million worth of shares in a company, it's just not that easy for them. So this is the inventory sort of problem that we run into. And then another problem is the word gets out on the street, which is also called front running, assuming that if there were 25 of these houses, right? Let's say by the time you get done investing your 20 million, and if the world knows that investor, let's just call him investor I, right? If the investor I is a really solid investor and he is buying into this new property project, by the time you want to invest all your $20 million over here and buy 20 properties, right? By the time you end up doing this, the moment you're just thinking about it, or talking to your developer, the word gets out, right? Everybody around you, other investors, just get interested in getting a piece of it, because your name sort of supersedes, or how you say it, that you're just very well known as a really good top-notch investor, right, in the market. By the time you think about it, or while you're in discussions, every other investor starts to hawk you. By the time you're getting done with buying 5 properties and paperwork with that, other investors are going to be like, okay, I want a piece of it too. By the time you get done with buying the next five properties, right? Okay, forget my spellings. But what's going to happen is by the time you're done buying five and then five, 10 properties all in all, other investors are going to go to the same developer and say that I can pay you 1.1 million for the same exact property, just buy it to me. What's the developer going to do? Right? So you understand the concept of front running and moving large capital. So that's the very first thing, Warren Buffett, or not even Warren Buffett, but any large hedge funds. And when I say large hedge funds, I'm talking about funds starting from 10 billion all the way up to like whatever Ray Dalio is currently managing at the moment. Right. So this is the exact same problems all of these funds fall into. Number two is info, right? They have a lot of different analysts actually researching the company and stocks, and they also have access to a lot of information that average investor just wouldn't be able to have. And when I say more information or access, I'm talking about they have access to the CEOs of the businesses or CFOs of the businesses. They can go out there and actually interview those people if they like those people, if they have any confidence in those people. We don't have that level of access. And another thing they have is influence, right? When these large hedge funds like Warren Buffett or any other very successful funds are buying businesses, they're not just buying shares like you and I. They're buying the entire businesses, and they're getting those sweetheart deals, and not just sweetheart deals, but they're also getting the influence, right? Because they end up becoming the largest shareholder of the businesses. They end up getting their way. And if they want to change the company a certain way or want the company to operate a certain way, if they think that is the better way, that's the kind of influence that they have. And even when I'm talking about sweetheart deals, right? If let's say the share of that company or the stock of that company is trading at $70 per share, they can go to the CEO and negotiate a certain thing that they can buy the shares of that company at $50 per share. They can go to the company and negotiate a much better deal other than common shares, but they can be like preferred shares, right? So they have their own benefits, right? They can also influence a company that they're investing such a large amount of money into the company, and they want controlling stake. A lot of times, a lot of hedge funds do end up controlling the company and run the company completely differently than what the company was originally running, and they just have complete control of that. It's more of investing in that company, and rather ends up becoming a takeover, or if not takeover, but a very a role where they have a lot more to say than an average investor like you and I. So they're not only getting that level of information, access, influence, and a lot of the research that you and I just can't go past. And the best we can do is really just look at the PR news, look at the balance sheets, look at the income statements, look at the sector, look at the previous sales numbers, profitability, debt. But a lot of these funds are getting a lot more information that you and I can really even get. Number three is understanding that capital is a tool, right? Investing is not something that you do because everybody says that it is a best practice for you to just invest your money into the markets, into the properties, into crypto, or into any kind of assets. Your capital is a tool for you to multiply your capital, right? Grow your wealth. That is the reason you invest in the very first place. And you have to have your North Star set right from the very first get-go when talking about investing. And what generally tends to happen is when people have this mindset of I buy the whole stock and I just hold on to it for 10 years, what they're secretly hoping is I'm going to buy into the next Apple. The next investment of mine is going to end up becoming the next Apple, and God, I'll be lucky. And how I just bought these 10 shares or 100 shares or 1,000 shares, and 20 years later, it's become the next Apple, and I'm the lucky billionaire or millionaire, whatever it is. So that's how people are actually operating in. And when it comes to using your capital, using the tool that you have to multiply your wealth, the right way to invest or the right mindset to invest is that you want to keep on compounding your money and growing your wealth over time, right? Wealth growth, that is the job as an investor, right? But let's say a stock doesn't really perform so well, and maybe the overall market just goes up by 10% or even 8%, let's just say, and your stock that you ended up buying, and it just goes up by 3% for the next 3 years. For those 3 years, your portfolio has actually underperformed. That's just dead money, essentially. Job is to just multiply your money and try to be as efficient as possible and generate those risk adjusted returns, right? Doesn't and that doesn't really mean for you to sit on a stock that is really not going anywhere, or maybe just going down in value, and now you're just sitting on a floating P&L, a negative floating P&L, or if it just goes sideways, that is just the opportunity cost, right? So that's just dead money. And we all want to stay away from dead money, right? And also, the next big problem that I have with this long term thing, when people just blatantly follow this advice, is people assume that things are not going to change. And if things are good with a particular stock, if the particular stock looks really healthy and is trending up, they are assuming that things are always going to continue being good and stay good, right? And if anything, we have all seen the examples of that rarely happens to be the case. If something is good, eventually it's going to get disrupted. Eventually, another company, another competitor is going to take some sort of a disruption is going to happen into the market, regardless of what market it is. If it's a stock market, if it's real estate market, we have example of that as well. Because people used to assume that properties always go up. 2008 really showed us that that doesn't really have to be the case. But even if you're talking about stocks, right? Think about BlackBerry. Think about Nokia. Think about Blockbuster, I believe it was called. If you're an American, you probably would know about it. Blockbuster and Netflix just completely came over and dominated them and basically just took them out of business overnight, pretty much. Fourth is something that we are all experiencing, the shift, and that shift is technology. Technology is changing, information travels really fast. And when we talk about Warren Buffett or any of the really successful investors of his era, these guys became super successful in an era where the technology wasn't so good. Information or news didn't really travel so quickly as compared to what happens today, right? Stocks or anything that happens to a stock or a company, or maybe earnings or new PR, we all get to know about those things in a few minutes most times, right? And if not few minutes, certainly in a day or two, most of us would actually get to know about what really happened if we are looking for it. And even if we don't really look for it, some of the other notification or alert just pops into our phone, just tells us that this is what's happened, right? So information and news really travels quickly, and things become good quickly, and things also just go out of business a lot more quicker. And the moves that used to happen uh, a few years ago, or basically in Warren Buffett's era, the 100, 200, 500% move if a stock just keeps on going higher and exponentially grow, those things used to take about 5, 7, 8 years. But nowadays we can actually see those things happen and we are still talking about fundamentally solid companies, not like pump and dump, which just goes about 6 or 700% and just comes crashing down, right? But we're talking about fundamentally strong companies that not only go up, and just also stay up. Information travels fast. People get on the new trend, on the new information, on the latest information, latest investment much more quicker. People make their money and also take their profits a lot more quicker and just get out of the markets, right? And that's also another reason that a lot of funds, a lot of small to medium to maybe not so much of the large firm, but the small to medium firms tend to be a little bit more active in the markets. And when I say active, they generally have a holding period of 3 months to 6 months at times. And this is what we're talking about, the smaller funds, right? And even when you're talking about, just to digress a bit from what we're actually talking about right now, I find it ridiculous when a lot of people particularly people who are not involved in the financial markets. They are like, hedge funds can't even beat the market, right? Hedge funds or mutual funds can't beat market, things like that. When they say things like that, I mean, it just doesn't really make sense to me, keeping it YouTube friendly over here, because what smaller hedge funds are actually doing, and like the very first point I was making, it's just a lot more difficult to move and compound really large amounts of capital. But when your fund is operating anything a billion or less, those guys tend to be a lot more active, and if you look for those funds, you will find those funds, and those funds are really generating 60, 70, 80%, sometimes even more if they're a superstar fund. And when we talk about bigger funds, they're not trying to beat the market always. If market goes up by 10%, their goal is not to beat the market. A lot of the times, right? A lot of the times, these really big, very successful hedge funds, their goal is to generate 7 to 8% return. But what their commitment to the investors tend to be is low volatility, right? Their investors really want the equity curve to look something like this, whereas an active fund would look like this, right? A little bit more volatile, as you see. This is what really large hedge fund managers are basically giving to their investors, this one. And investors who are a little bit more aggressive, they're looking for this. They don't mind a little bit of volatility. Now, still, they don't want their portfolio to go down and have swings of 20, 30, 50%. But they're okay to take those swings of 15 to 20% sometimes when they're in a drawdown, but they want that exponential return with their portfolio, right? But also coming back to the whole technology thing, right? That we were talking now, the whole, we sort of went off topic over here with the hedge fund, but let's just cancel it and stick back to this area over here. First of all, the information travels really quickly. And the second one is industries also evolve quickly and also get disrupted a lot more quickly. Think about AI, electric vehicles. Next one looks like to be robotics to me. So things come and go a lot more faster as well. So it's very, it's ignorant for us to think that we can buy a stock or buy any investment that's going to continue to compound and continue to do better over long term, and not really calculating or assuming that if things change or things could change, right? And not only it is ignorant, but also could end up being a lot dangerous for a lot of investors, when they just destroy their wealth pretty much. And the fifth point, last but not the least, is exits, right? This is something I already touched upon a little bit earlier, anyways, that investment is simply an item in your portfolio, and it's not really doing much other than the fact that it's making you richer or poor on paper, right? An investment is something when you cash out, when you take your profits, when you have a solid exit strategy, not to use this as a reason to exit quickly, because that's what a lot of investors end up doing, that they exit a lot earlier and they don't really give enough time for their investment to actually work. But you have to have a very solid exit strategy. Maybe that exit strategy is based on fundamentals, right? If the company's fundamentals just changes, then it's no longer a valid investment in your books. And whatever your rules were for that investment, maybe it's consistent earnings growth, or consistent a certain percentage of the market, or maybe there are no competitors for that particular stock or for that particular business. Could be those, could be technical reasons, right? But you have to have some level of some sort of exit strategy that works for you, that works for your system, right? So that is something you have to think about. But otherwise, investments go up in value and also come down in value. And I know so many stories, maybe not so personally, but I've heard these stories thanks to internet, that people started investing with 5 million, and that they turned that 5 million investment into 50 million really quickly within a couple of years time or few years time. And before they knew it, they did not really take any profits. They did not really know how to exit or when to exit. And that 5 million became 50,000. That 5 million went all the way to 50 million. and came back all the way down to 50,000, right? So there are stories, right? These are the happenings that do happen. So you have to be mindful of what you're investing in, how you're investing it, what your methods are of investing, and knowing when to really cash out. So those are a few of the reasons that this advice of Warren Buffett or just holding things for the long run, as sound as this advice is, it really doesn't apply to 95% of investors today who are looking to be a little bit more aggressive in terms of their wealth growing goals. I'm talking about risk adjusted returns, right? Where they're not risking too much, where the capital is just too much in danger, but they're also not happy or satisfied with the same market sort of 10%, 12% returns. Now, this advice is really something valuable of an advice to follow. And the person who would greatly benefit from following this advice is somebody who really just does not want to be super active in the markets, and they're happy to have maybe similar to market returns or slightly better returns, right? And to in this day and age with technology changing, with everything changing so quickly, I think the better way to implement and apply this advice, if you're somebody who really doesn't want to look at their portfolio for years and years to come, or you really don't want to be so active or be, something that you even thinking about your portfolio, if that's you, then the right way to apply this advice. And for that, I'll tell you the different types of risk in the market, right? Number one is market risk. This is the least amount of risk. If you buy the overall market crashing, those odds are significantly lower, right? The second slightly higher risk is your sector risk. The likelihood of a sector crashing is slightly more higher than the overall market crashing. But in the grand scheme of things, entire sector crashing, that is again very, very low, right? And then the most riskier one would be stock risk. If you're somebody who's just wanting to follow this advice and be extremely passive with your investment, I would say the better way for you to expose yourself in the market would be just stick to the market, stick to exposing yourself to the overall stock market. And that could mean that S&P 500, right? IWM, small cap, right? ETF for that. And buying things like that where you're just exposing and taking on the entire market, and you are very well diversified to the point where no one or two stocks can, if they end up going down by 50%, it's not going to affect your portfolio. And if you want to be slightly more aggressive, maybe you're slightly more in tune with the technology sector, maybe in the oil sector, because that happens to be also tied to your professional life, or if you happen to have a bit more learning or understanding about that particular sector, maybe you can slightly be a bit more risk, take on a little bit more risk and expose yourself to the sector risk, right? And the way to invest into these things would be, and then stocks tend to be the most risky of all, right? Because one company can easily go out of business tomorrow. So that is the maximum risk that you're exposing yourself to. And with something that we discussed earlier, how quickly things can change. So if you really want to be extremely passive and hold things, don't bother exposing yourself to stock market risk, right? And a stock could just go up by 200% and could also come down that much more quickly. So, and the way to invest in the overall stock market is when things are just going up, don't even bother. Whenever you have a paycheck, just buy some more. The next month paycheck, buy some more, buy some more, buy some more. And before you know it, by the time you're retiring, you're going to amass a lot of wealth in your own portfolio. And this is guaranteed to not make you rich quick, but it is also going to be a guarantee for you to be financially independent, right? So you're guaranteed to not be rich quick, but you're guaranteed also to be financially independent. The only pitfall or the downside, a lot of maybe not downside, but actually a pitfall a lot of investors fall into is they lose their patience. They get caught up into the new hype, new FOMO, and they lose their discipline, and they basically whatever they would have made in the last 2-3 years, and their investment wouldn't have even completely gotten a chance to start compounding for them yet. they would lose a bunch of money in a hype stock, right? Which goes up and comes all the way down. So just don't fall into these traps. Don't expose yourself to this level of risk because you really don't need to. And if you see an overall market crash, just things are at a discount, buy some more, right? And that's the best way to follow this advice if you're somebody who's really looking to be passive. But I hope this video gave you a lot more clarity about following this advice. And if you're somebody who still wants to follow this advice, what's the best way to do it? That's about it for this video. If you're somebody who's interested in taking your investing game to the next level and wants to learn how to invest in the markets the right way, properly, professionally, and you want to be able to grow your portfolio exponentially and consistently beat the markets in 5 minutes or less, consider checking it out. There's a link in the description below. But that's about it from me in this one. Like, subscribe, and I'll see you in the next one, guys. Take it easy. Cheers.